CPA, and on this channel my goal is to empower you by discussing various US income tax topics. While these videos and the channel overall are informative, they're by no means a complete tax guide and should never be taken as professional advice in any way, shape, or form. This channel is also not educational and none of the videos are eligible for CPE credits. My goal is purely to inform you and make you aware of various tax-related issues, uncover the mysteries of US income tax, and broaden your perspectives. So let's get started. Up next are moving expenses for members of the armed forces. In the past, it used to be the case that moving expenses were applicable to many people, but now it's only for the members of the armed forces on active duty and if the move happened due to a military order and permanent change of station. Obviously, you can only deduct the amounts that are unreimbursed to you. The qualified expenses include the cost of moving your household goods and personal effects, as well as reasonable travel and lodging expenses from your old home to your new home. Non-deductible expenses include the cost of stopovers and side trips if you did not take the shortest and most direct way from your old home to your new home. The next item on our list is the deductible part of self-employment tax. Now, absolutely every person pays this tax, but this particular line is only applicable for people who are self-employed. Or if you're an employee and you also are an independent contractor or you have a side hustle, you can also use this line. But if you're only an employee, you cannot subtract those taxes from your income. So very briefly about self-employment tax, what is it? It's a tax that consists of two taxes: Social Security tax of 12.4% and a Medicare tax of 2.9%. The total is 15.3%. If you're an employee, you're only responsible for half of the 15.3%, half of Social Security and half for Medicare. The other 50% is the responsibility of your employer. However, if you're self-employed, then you're responsible for the entire thing, for all 15.3%. And that's unfair, right? So what the IRS says is that 50% of what you've paid on your own is deductible as an adjustment to your income. There are other additional rules to this. I'm not gonna get into this because, as I said, this is a very brief, very short summary of your adjustments. Line 15, self-employed pension plans. Okay, I will try my best to explain this in the simplest and shortest way possible. This is available for self-employed folks again, and first one is SEP, that stands for Simplified Employee Pension. These are accounts that can be set up for both the employer as well as the employees, but the contributions can only be made by the employers. And obviously there are limitations on how much you can contribute. So if you're contributing for your employees, it's relatively easy to calculate. So it's either 25% of the compensation of the employee or $57,000 for 2020, whichever is less. When it comes to determining how much you can contribute as an employer, it is not as easy. The calculation that the IRS provides has a circular error, so it's actually very difficult to calculate how much you can contribute for yourself by just using a formula or doing something. So it's much easier to follow the IRS table that's called a Table of Reduced Plan Contribution Rates that is included in publication 560. Keep in mind that the deduction is based on how much you can contribute. So before you know how much you can contribute, you really don't know how much you can deduct on Schedule 1. But for the deduction amounts and purposes, there is a limit of the amount of annual compensation for 2020 is $285,000. The next one is SIMPLE, which stands for Savings Incentive Match Plan for Employees. It's only available for small businesses of 100 employees or fewer, and if you do choose to use that plan, it has to be the only available plan. So this plan consists of two components. First one being salary reduction contributions. Those are the contributions that are made by the employees. So if the employees say, I don't want to get a check for the entire compensation, I want a part of my check to go to that simple pension plan. So the amount that the employee can defer under simple IRA plan is up to $13,500 for 2020. And if your employees are over 50 years old, they can contribute up to $3,000 more as in a catch-up until 2021. The other component of simple IRA is the employer contributions. It has two options for you. You can do either a matching contributions or a non-elective contribution. So a matching contribution means that you are matching your employee's contribution dollar for dollar up to 3% of the employee's compensation. If you don't want to do that, you can elect the non-elective contributions of 2% of each eligible employee's compensation. And keep in mind that employee's compensation that is taken into account for this specific calculation is $285,000 for 2020. So how much of the maximum contribution can you make for yourself on your simple IRA? It's also $13,500 for 2021 and 2020. Your contributions obviously cannot exceed the earnings from your self-employed business. If you are age 50 or older, you can add up to $3,000 in extra contributions as a catch-up. And the last one are qualified plans. There are two main types: defined contribution plans and defined benefit plans. Defined contribution plans have a few different types. Profit sharing plan, in which you can decide how much to contribute on an annual basis, up to 25% of compensation, or not to exceed $57,000 for 2020. Money purchase plan is another one that requires you to contribute a fixed percentage of your income every year, up to 25% of your compensation. Defined benefit plans are very traditional pension plans that are slowly dying in the US. I haven't seen too many of those. Not many companies, not many employers choose to do that because it puts a lot of risk on the employer, and you have to hire an actuary to calculate the amounts that you need to contribute every year for the employees and things like that. So it gets progressively more complex as I speak. So I should probably go to the next slide, which is self-employed health insurance deduction. Self-employed health insurance deduction. That's an interesting one because intuitively you would think that you report this on Schedule C, but no, it is actually an adjustment to your income. The deduction cannot exceed your self-employed income, and you can also not take the deduction if you're eligible for an employer-provided health insurance. Next up are penalties on early withdrawal of savings. So if you have a certificate of deposit or some other time deposit accounts and you decide to withdraw money from those accounts before they mature, you will definitely pay a penalty. And those penalties will be reported on your 1099 interest form or 1099 original issue discount form. And those penalties can be used to reduce your gross income. Alimony. These both alimony lines only apply to divorces that happened before 2019. You should know what alimony is not. It is not a child support, and it is not a voluntary payment. The way that alimony payments are treated after 2018 are neither income nor adjustments to income. You disregard alimony payments. If you enjoyed this video, give it a like, subscribe, and hit the notification button so you don't miss any of the future videos, and I hope to see you in the next one.